The 2008 crash happened due to mortgages and CDOs. And the next one might be because of corporate debt and CLOs. The financial systems have changed, but the risks have not. In today's video, we will be talking about the ticking time bombs which might cause the next recession, like the increasing number of corporate debt, the rise in amount of CLOs, which is kind of similar to the CDOs which caused the recession in 2008, the yield curve screaming recession, and the political feud between Donald Trump and Jerome Powell, the chairman of Fed, which might shake the US dollar itself. This is not financial doomsaying, and we're not trying to scare you. Let's get into today's video by knowing where it all started from. Before the COVID-19 recession, the interest rates were rising and the corporate debt was at $72 trillion in 2019. Fast forward to 2020 when the recession hit. The Fed and the US government overreacted to the recession. Why? Because they printed $3 trillion itself in 2020 when the recession hit, and they added $12 trillion of cash stimulus to the economy. And the interest rates were slashed to near zero. Due to these factors, corporate debt went from $72 trillion to $100 trillion, nearly 100% of the world GDP, which leads to the fact that the corporate debt now is more than the GDP of the United States of America. But why all of these things even happened in the first place? Well, because of the fact when interest rates crashed in 2020, the companies rushed to get more debt because the debt was very cheap. Because whenever the interest rates are lower, the debt also gets cheaper, which is why companies went on to get this debt to either survive or to grow. But here comes the problem. The companies which took loan in 2020 and further years had to face the fact that the debt was floating rate. So what exactly is floating rate? Like I explained you before, whenever the interest rates are lower, the debt is cheaper. But when the Feds went on to increase these interest rates in 2022, the debt became way more expensive. And it became hard for companies to repay this loan. But here comes the most interesting part. If you remember in 2008, the recession was caused due to CDOs, collateralized debt obligations. These CDOs were filled with subprime mortgages, which are complete junk loans. What do I mean by subprime? Subprime means a loan that is at a very high interest with very less collateral. And these kind of loans are complete junk. But these subprime mortgages were sliced into tranches and they were sold as AAA products. AAA products usually mean that they are safe and have very low risk. But when these AAA tranches are filled with subprime mortgages, these kind of products are intended to fail, which is what happened in 2008. Now today we have CLOs. So CLOs stand for collateralized loan obligation. These are just like CDOs, but instead of mortgage loans, these contain corporate debt, usually from companies that were bought from leverage buyouts. Now you will ask me, what is leverage buyouts? So if you remember from 2020 onwards, there was a very big spike, not only in markets, but in private equity as well. You might have witnessed a lot of private companies' valuations skyrocket like anything. And whenever private equities wanted to buy or take stake in these firms, they used to do leverage buyouts. Because for an example, if you are a private equity firm and you want to buy 50% stake in a private firm or startup, now in a normal acquisition, if you want to get 50% of a startup, you would give $5 million to the company and you would in return get 50% equity. But in a leverage buyout, the private equity firm will only need to give $1 million, that is 20%, and they will finance the rest of the 80%, that is $4 million from the bank. And this is called as leverage buyout. This 80% of finance from the bank, this loan will not go to the private equity firm, but rather it will go to the firm which is being acquired. Now imagine the fact these type of deals have happened nearly 10,000 times since 2019. And now considering the fact that these type of deals go up to hundreds and millions of dollars. In 2019, the corporate debt default rate was near 2.5%. And now it is near 4 to 5%. Considering these data, some analysts are expecting a near 8% default rate by 2026. The only thing that can resolve this issue is interest rates, where Donald Trump and Jerome Powell have been fighting. Jerome Powell wants to keep the interest rates high because he fears that if he cuts the interest rates too fast, the inflation might come back. But on the other hand, Donald Trump insists that these interest rate cuts should happen because if it doesn't happen, the economy might fall out. The default rates might increase. Now, considering the fact that there might be rate cuts in September, but we should not even forget the fact that there is a lot of euphoria in the market. The markets are now back up to their near all-time highs. Now, lately, the sentiments of masses and the normal retail investor have been that the market went to its bottom and now are back to their all-time highs, and the future looks good as usual. But we should not forget about the most important thing, That is the yield curve. So the yield curve is the most accurate technical indicator for recession. It has predicted the 2008, 2000 and even the 2020 COVID crash. There is something more worrying about it. From 2022 till 2024, the yield curve was inverted for nearly 18 months, the longest time period ever. The last time it ever happened, it was before the Great Depression. So does it mean we might face a depression again or even a recession? Because every technical indicator out there is actually signaling one. See, we can never time the market. We can never know when the recession is about to hit. But the only thing we can do is look at the important indicators like unemployment data, default rates, corporate debt market, how well are the industries working in the economy. Because remember, the most worrying things about the market and a recession is not in front of it. It's actually beyond it. Until then, don't forget to give me your analysis in the comments down below and do follow Beyond Bull and Bear and don't forget to have a great day. Thank you so much.